And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
And we're back. Hopefully, we got sound out there. Is this working now? Okay, I'm just going to assume it is, and Holden will tell us if it's not the case. Anyway, round two. Welcome to Coach's Playbook, Tuesday, July 19th. Today, we're talking about how to cash in on a winning trade. We're talking about holding winners. First, see if I can repeat my same line from before, Dan. I hear you have the name of a trader who was holding a winner today.
Yes, we do. We got Aaron Joe trading some NASDAQ, taking advantage of some of these really nice moves up about $4,000. But he's not the only one. We got a number of people up on the board doing really well, taking advantage of some of these moves.
That's great to hear. Holding winners is really one of the toughest things for new traders to do. I see, we talked about during our trading strategy course we just finished up, how holding on to losers, the whole idea of loss aversion and psychology is very important here, but holding on to winners for an extended period and then having complete conviction to hold on to losers way too long is a very common problem we see. Hogue, why do you think that is?
Well, because I think most of us are hardwired to defend ourselves against losses and to take winners. I think most of us are, well, putting your first trade on, if it's a loss, we usually default to, well, I'll just wait. The market will come back and make me whole again, or something.
Always does.
Effect. Yeah, always does, right? We just end up creating bigger losses. And the other side of that coin is when we get that first winner, boy, it sure feels good to take that first winner, even though it's $50 and you just lost 500. Professional traders do things the opposite. They know when they're wrong. They get out cheaply and they learn to hold on to those winners.
What's interesting is it is counterintuitive, because think of the old saying, a bird in the hand is worth two in the bush. Not really the case in trading. You got to figure out the probability of getting those two birds in the bush. And it's not easy for people to get into that sort of mindset. Dan, how about you? How do you look at like holding positions? Because I know Hogue doesn't even set stops often for trend trades.
I won't set profit targets, but I always have a stop.
Yeah, as I said that, I knew that sounded wrong. But Dan, how about you?
Yeah, I mean, I want to kind of dive into this idea of art form. First off, number one, if you're trading all in, all out, one lots or two lots, right, and you have no strategy around scaling in and out of your trades, you set your target. When you get into that trade, you got to look at where I'm destined to go, right? Like, here's where I need this market to go. That's going to be my out, and that's going to be it. Now, if you've kind of gotten past that and you're growing as a trader, you can start thinking about this idea of scaling in and scaling out. And I think that's where a lot of traders really want to get. And so that's really what I wanted to talk about today. So number one, the same strategy applies. You look for your entry, you define your entry, define your exit, and you find that profit target. Let's say you're trading 2 full units, and to you, a unit is a single contract. Your entry point, you can load up in there, right? You can you can put your whole trade on. You can adjust how you're getting into that trade too. But let's simplify and say you're getting into the trade at that point. The next thing you want to do is, as that market starts to approach profit target number 1, you can start to scale out. You can take that one lot off. Then you can start thinking about, hey, now I can think about this idea of trailing my stop. You can bring your stop up a little bit and ensure you're locking in some sort of profit. And that's where you can let that second one run. That's what they kind of talk about. Let your winners run. Well, there's got to be some strategy inside of that. You can't just be putting on a trade and letting every single one of your trades run. But if you get a directional move, you can take one of those units off. You can let that second unit start to run. And to me, that's really where this idea of letting your winners run. But the only way you can really do that is, first off, if you've gotten comfortable defining that initial profit target. If you haven't defined that initial profit target, you're going to struggle every single day of your trading because everything's going to be different. You're not going to create consistency. So step 1, learn on just getting in and out. And then as you get comfortable with that, you've defined where, hey, I've gotten really good at picking out where this market's going to go. I've done some back testing. I kind of know how this market's moving. I know how my strategy works inside of this. Now I can start thinking about letting that winner run. So that's how I look at it. Number 1, get comfortable just getting in and out. Then you can start to adjust sizing and take advantage of some scaling. We've talked a lot about trailing stops. I think about a year and a half ago, John and I did a awesome class on trailing stops in and of themselves. I know it's out there somewhere. So go look at that. And then you can start thinking about the opposite and scaling out or raising those profit targets. But make sure you're doing it within a strategy and not just whimsically.
We said
this looks like it's going to go.
We said don't do anything willy-nilly in trading strategies, which is a fun word to say. I agree with you that scaling is something that definitely helped me get better at holding on to winners, because you feel like, you have to lock in at least something. I love my little thirds rule where I'll be like aggressive on the line and then a little defensive with one. But as long as you're kind of like following your strategy, then you can feel confident doing that, but not just like, this feels like it's time to peel one of these bad boys off.
I think you're right, Jack. Like you have to find a way to get comfortable letting it go. And then that's when you peel one off. Okay, you're not losing on this trade. Maybe you're not going to make $1 million, but you're not going to lose. And now you've got some comfort to let it go.
Yeah. JD, do you use trailing stops, or are you a purist?
I'm a bit of a purist. We've done actually a couple of coaches' playbooks on this. I am not a fan of the trailing stop. They always just knock me out, right? I'm going to piggyback a little bit what Dan and Hogue both just said when it comes to getting out, though. I mean, it's more than just what kind of trade you are. Are you looking to hit that home run every time? Are you okay taking small profits? It's more than that. It really depends on what kind of setup you're looking at too, or the circumstances that got you into the market in the first place. Were you looking at a sharp pattern with a measured move? Was it a range trade or a breakout trade? Are you swing trading? Are you looking for those longer term trades? Different setups have different risk rules. I know during the trading strategies course last week, Hogue talked a bit about the flag pattern, which is a very common chart pattern that I like to trade to. We use the bull flag for this example. When you're looking at it, the minimum price objective for a trade like that is the flagpole extended from the breakout line, and that's your minimum target. So when you're playing that kind of range, you could even scale into the position and scale out. If you're looking to play the breakout, exclusively, I wouldn't size up on that. I would just look for that one measured move. Mm-hmm. Otherwise, you could play the opposite end of that channel line, scale in with minimal risk at that point too, and then scale out, get out of one at your price, price objective, and let one run.
Right, is always preaching the gospel of asymmetric opportunities, right? And this is where it comes in, is that it's going to be very hard to be a profitable trader if your average winning trade and losing trade are of a similar magnitude. Now, that's especially true if you're trading outright futures, which most of you are, obviously in the Top Step program, there's other ways to trade. I mean, like in my career, it was a lot of make a little each day and then control your blowout. But if you're trading outrights, it's got to be the other way, right? So Hoag's usually looking for at least 2-1 on those, and you got to be comfortable holding on to something in the green if that's going to work out.
And it is a muscle that you really have to develop. I mean, yeah, I don't even think about taking a trade unless I can reasonably and probably expect a 2-1 reward to risk. And those are usually going to be range bound trades. When it comes to range bound trades, I always have specific targets. And because we know the scope and the size of the range, there's always times when it doesn't reach the target. And of course, that's another story about trade management. But the profit target is always about the context. JD was talking about the bear flag or the bull flag. Those have very specific first exits, and you can place your profit target there. If you get wonderful, great, right? So in a range bound trade, I think it's easy to pick profit targets. In a trend, it's much more difficult to pick profit targets. That's why I tend not to put a profit target in trending days. We've got a trending day going in the S&Ps right now. We've got Aaron Joe long NASDAQ and just riding the market to the upside. We don't know how far the market can go. So if you're going to be using a profit target, you're going to maybe be cutting off a good trade relatively early. We don't know exactly how any trade is going to finish. So there is no perfect exit. If you're trying to find the perfect exit, you're going to hem, you're going to haw. It's going to end up costing you in the long run. If you end up selling the high tick or buying the low tick on uncovering a trade or liquidating a trade, it's luck. It doesn't make you a genius. Maybe once or twice in my career, I have done that, and I felt like a genius, but I know how lucky it was. And there's something that I always call the 10% rule. When price is approaching within 10% of a profit target, I'm allowed to take the trade just before it reaches profit target and call it a full profit target hit. Because again, there's no perfect exit. If you're ever trying to be perfect in futures trading, it's going to be frustrating for you for a long time. So take the trades, take the profits, move on to the next trade. Whatever happens after your exit is a new situation, a new opportunity.
I wanted to chime in really quick and mention one thing with Mick being out and me actually being at Mick's house in North Carolina. I'd be remiss if I didn't use some of his words of wisdom. But Mick said this quite a bit over the years. I know he said it to pretty much everyone he's talked. As day traders, your job is not to take the entire piece of the move. Your job is to be able to find those chunks. And so if you are looking to kind of let that profit target run, that's totally okay. But don't feel like you have to take it to the nth extreme. Get to a point where you're comfortable and peel that trade off and move on. If the market continues to go, great. Maybe you look for that little bit of weakness in that uptrend. You've got another opportunity to buy, and then you can take another chunk. But your job is not to take the entire thing, get little pieces, and continue to grow that account.
That's a good point. If that were true, the richest people in the world wouldn't be Bezos, they'd be traders. You can't be perfect in this industry. So don't get down on yourself. If anything, I think the discipline first should come from the flip side of this coin is the holding on to losers too long, which we don't have to dwell on too much. But I mean, that's a good trade. If you get out at your stop and you didn't move your stop and you didn't do anything dumb, that's a great trade. That's going to happen. Trade. Gotta get used to it. So anyone else have any final words of wisdom they want to add here before we take this bad boy home?
Well, one last thing. Our friend Aaron Joe, who's up $4,000 today, when he gets paid, when he takes payment, he's going to get, well, if he hasn't already gotten 100% of the first $5,000, he's getting 90% of it now.
Hoag, you are on message today. Yeah, we just switched announcement today that now 90% is the amount that you are keeping of your earnings in the funded account. So gold star for Hoag right there.
So take profits.
Get out there, take profits, and succeed. Dan, do you have a quote for us today? I don't want to
I
force
do.
it.
No,
Perfect.
I do. I got a quote. Don't worry. I actually really like this one because in trading, when you're in a good trade, I think Hoag's talked about it a lot too, right? You're uncomfortable. So Robert Arnott, in investing, what is comfortable is rarely profitable. So put yourself in a little bit uncomfortable position, manage your risk, and hopefully you can do well with that.
So true.
Yeah. Embrace the discomfort. We'll see you guys next week. Until then, farewell.